winning again is very high, 70, 80, 90%, and sometimes. And the best is you don't need to monitor your trade every day if you don't have the time. The holding period for this particular strategy, 24 hours sometimes, or slightly more than 24 hours, or sometimes it can be a couple of days. And usually, even though we say 14 days, but very, very seldom the trade will last for 14 days. Usually it's less than that. We sell at $1 as an income, then we usually will buy back at a lower price. We'll buy back maybe at 40 cents. So we make the difference 60 cents. And our duration of the trade usually is less than 40 days. One of the strengths about this strategy is it creates a defined risk, and the investor can decide for every trade how much risk they want to take. What I mean by defined risk. Now let's say the price is trading this way. Right now it's trading at about $30. And you believe that this market is unlikely to trade below, let's say $20. We sell a put option right at $20. Buy at the same time. We buy below $20. Let's say $18. So we sell and we buy at the same time. This is called credit spread. So what is our risk? Our risk maximum is $2. The difference between the two price, $2. So $2 is our maximum risk. One of the benefits about this strategy is we know what is our maximum risk. Now, so if we sell a $20 and buy an option at $18, we will receive, let's say, example, let's say 40 cents, right? Receive 40 cents. So now our maximum risk is what? $2 minus 40 cents. So our maximum risk is 160. Price can go up, we make money. If the price go down, we don't care how far it go down. Our maximum risk is only $1.60 per share. If you have 100 shares, you multiply 100, that means it's $16. If you have 1,000 shares, it's $160. So the good thing about this strategy is we know the defined risk. Okay, credit spread is what I'm going to introduce to you. This credit spread is basically we buy and sell at the same time. And this strategy is best for those traders who have small account. Uber is trading at $37. So I want to sell a put at $30. It means that I only willing to buy Uber at $30. So in other words, if I want to sell Uber at $30 for 1,000 share, I need to have 30,000. So if you don't have 30,000, the broker will give you margin. So you don't need to have 30,000. All you need to have is 6,000 to sell 1,000 share on Uber at $30. If you don't have $6,000, all you can do is you can use credit spread. That means you sell an option at $30 and you buy, let's say $28. So you sell and you buy. This is called credit spread. Your maximum risk is $2 minus the premium they collect. So take a look at this example. The premium received is 33 cents. So 1,000 shares, you receive $330 US. How much capital needed to sell 1,000 shares using credit spread? You need only $433 instead of $6,000. So that is the beauty about this strategy. It's meant for small account investor. Instead of $6,000, now you don't have $6,000, never mind. But your account should have this money, right? And then you already can sell 1,000 shares. No different from another trader who have bigger account, he sell 1,000 shares. So that is one of the benefit of our credit spread. So what is the ROI? The ROI for that Uber over the next 29 days is 12.4%. Now, 1 month, what kind of investment can you get 12.4% in 1 month? Very difficult, right? But if you annualize this return, in 1 year, you are making triple-digit return, 156%. And that's the reason why people are making good money in option. If you know the right strategy to trade. Now, why sell option? If you are the buyer of option, the market can have only these 5 directions. Out of the 5 directions, you already lost 4. You only win 1. That is your odds if you are buying option. But if you are selling option, this is your odds. You win 4 out of 5, right? That's the reason we want to be an option seller and not a buyer. The odds of winning is 4 out of 5. This is basically right. Our winning percentage is 80%. Can you see now? As an option seller, our winning percentage is 80%. Their winning percentage is only 20%. Option buyer. As an option seller, our percentage is 80%. Because it's a zero-sum game, right? If seller win 80, the buyer have to win only 20. Why would you want to be a trader who only win 20% of the time, right? That's the reason why you don't want to be an option buyer. Okay, this is a typical trade alert which I share in our community. Now, this is for traders who do not have time to look for trade yourself after you attend my workshop, and you just simply want to make some good money and follow my trade. So you subscribe to my trade alert, and this is exactly a typical example of what you will get. All informations are already there. You can see this is the date where I post the trade. I will tell you what company to buy and sell, Microsoft. What kind of option are you going to, in this example, is a bull put spread. We are bullish. When this option going to expire on the 11th of September, right? And what price? We are going to sell 217.50 and we buy 215. So our maximum risk is how much? $2.50. We don't care where the price goes to. If the price goes up, we make money. If the price goes down below 217, we go to 210, our maximum loss is only $2.50 per share minus the premium that we receive. So our maximum loss is about $2.09, irregardless where the price goes to, right? Our winning probability is 79%. You can, again, I repeat again, you can never see another investment vehicle where you can know what is your odds of winning, but options allow you to do that. Now take a look at this example. This is Microsoft. I think, yeah, correct, Microsoft. You already see from there, Microsoft. The price is trading at 231. So I create a contract which only lasts for 9 days, which is denoted by the vertical line. In other words, and I sell 217.50 and I buy 215, which I just explained, right? So in the next 9 days, so long as Microsoft, it can go up slowly, it can go sideways, it can go against me, but so long it don't trade below this line, 221, I make money. It can go down. The moment it go down below, then of course this one I will lose. So all 4 directions, I make money. That is how we make money. Now I'm going to share with you another example. This is a US Treasury Bond. You can see from there, 20-year bond. And the way we trade is so different from traditional trader. Now traditional trader will try to predict where the price direction is going to be. They always predict, is the price going up or is the price going down? Or they always try to predict the direction. Now, that is a very, very difficult challenge to predict accurately where the price is going. If the professional already cannot predict accurately where the price is going, how can we as a retail trader predict accurately, right? So that's why a lot of people are missing have this missing link. They try to predict where the price is going. I'm going to tell you, this is not how we trade. And you are going to have this aha moment when the moment I explain to you. Now take a look at this US Treasury bond. It has rocketed up like this until here. You see this kind of parabolic movement until here, right? This is March. This is 6th of March. So after market have get up like this, I do not want to predict where the price is going. But what I'm going to do is I want to predict where the price is not going to go. Now this is a big difference there. Huh? I do not want to predict where the price is going. I want to predict where the price is not going to go. So after the price has rallied so high and get up, I want to predict I think that the price is unlikely to move all the way up to here, which is 185 in next 30 days or 2 weeks. The price can go up, it doesn't matter. But so long as you don't trade 285, I make money. So I'm betting that the price unlikely to trade above 185 for next 30 days. Right? So what happened is I sold a credit spread with 185 and I buy 190. My maximum risk is $5 less whatever premium I receive. So what happened is I enter here. After this candle here, I enter, I sell. So I sell here. Means I think that price unlikely trade above that. Right? And you see what happened? Next day, the price get up again. Right? Get up again. But I'm okay. Right? So long as it don't come here, I'm okay. Right? So what happened is, this is 1 day, 2nd day, 3rd day. Now market close here. Market close here. Now, I sell a contract which is more than 14 days for this particular contract. But after 3 days, I close my trade. Why? Because I receive, when I sell a contract at 185 and buy at 190, already I receive a premium of 90 cents. I receive a premium of 90 cents. And after the 3rd day, the market closed back down. I see that after 3 days, I can buy back this contract and close the contract with 45 cents. I already received 90 cents before that per share. I can close the contract after 3 days with 45 cents. I decide to go ahead and close the contract. Means I buy. When I buy, I have to pay 45 cents. But when I sell, I receive 90 cents. So for 1,000 shares, right, my net profit is $450. Only 3 days. My ROI is 11%. If I annualize the ROI, is 1,335% annualized return, right? What kind of business you can generate this kind of income?